Good afternoon. I have 12:30, so we are going to go ahead and get started today. Welcome, and thank you for joining us for this very important discussion on year-end tax planning for farmers, strategies for the current environment. I'm Madison Farnan, Manager of Marketplace Engagement at FCS Financial, and I'm excited that you're joining me this afternoon. A quick few notes before we get started. Cameras and microphones are disabled, but I do encourage you to submit any questions or thoughts you have throughout the presentation in the chat or the Q&A feature. We'll be monitoring that and we'll be able to answer some questions at the end. As we near the end of 2025, tax decisions become critical, especially with the unique challenges and opportunities that are faced in the agriculture industry today. And I am delighted to introduce our presenter for today's webinar, Jessica Lehmen, CPA. Jessica joined Williams-Keepers LLC in 2008, having graduated summa cum laude from the University of Missouri with a bachelor's degree and a master's degree in accounting. She specializes in tax and accounting services for businesses and individuals with a deep emphasis in agribusiness, state and local taxation, and retirement and employee benefits. Jessica is an active member of the American Institute of Certified Public Accountants and the Missouri Society of Certified Public Accountants. She also gives back to the community by serving on the board of the Columbia Center for Urban Agriculture and on the committee for the Heart of Missouri United Way. So without further ado, I'll turn the floor over to Jessica. Jessica?
Thank you, Madison. I am going to go ahead and start sharing my slides. Give me a second to get that loaded. All right. There we go. So good afternoon, everyone, and thank you for being here. I know you have plenty of uses for your time. As someone who grew up in agriculture and works closely with farm families every year, I know how important year-end decisions are. Today's session, Year-End Tax Planning for Farmers, is meant to give you some actionable guidance on the strategies that matter most in today's environment with today's laws. The tried and true income deferral and expense acceleration options that you've practiced through the years are still available, so we'll spend most of our time today talking about rules that have recently changed or items that might be new for this year or for the future. I'm really glad to have this time with you, and I'm grateful for FCS for providing this opportunity, and I hope it helps bring some clarity to your planning as we head into 2025. So on that note, let's get started. So what's new this year? There's always something new when it comes to tax law, but this year is probably bigger than average. There was a tax law passed last summer, so many of these updates are directly from those major tax changes. A lot of the changes are really extensions of existing or resurrections, maybe, of existing rules or rules that existed in the past, and depreciation is one of them. This is probably the single most important thing to all of you on this phone call, knowing that you're in an equipment-heavy business. These are things that you probably are used to acting on towards the end of the year, but I'm going to spend a little bit of time to explain what the rules are for this year so you know exactly how you can take advantage of them. So bonus depreciation, or 100% bonus depreciation, is back. So all of us in the tax planning world are quite happy about that. But there's some special rules related to that that we'll talk about for a little bit. So like I said, it's back. Bonus depreciation has existed for a long time. It was at 100% for a few years after the 2017 Tax Cuts and Jobs Act, but then it was scheduled to phase down 80%, 60%, and 40%. And so that this year being 2025, was going to be a 40% year, which meant that of a new equipment purchase for 100,000, you would have immediately been able to deduct 40,000 as bonus, and then the other 60 would go on a regular 5 or 7 year depreciation schedule. For acquisitions that are both acquired and placed in service after January 19th, 2025, we're back up to 100%. So you get immediate expensing for a lot of those purchases. Your accountants are going to be asking you about specific dates for when you acquired things. That's because January 19th is important. If you had a signed binding agreement to purchase something on January 18th, this 100% bonus depreciation is not an option for you. You're probably also familiar with 179 deductions, which are very similar in that it also allows you to deduct nearly the entire purchase price or the entire purchase price, depending on the situation in year one. But when bonus is around, it's just so much more flexible. Nobody talks about 179 usually, and I'll talk about a few caveats to that later on. But 179 has been in existence for a very long time. For a while, the deduction limitation for 179 was only $25,000, which most people easily surpassed. But the new tax act over the summer increased it up to 2.5 million. So 179 is limited to only small taxpayers, but small in this case is pretty big. So until you have investments in qualified property in excess of $4 million in a year, you can still take 179. So the vast majority of family farmers totally fine with using 179. But why would we choose 179 versus bonus? Well, there are a few key differences. So bonus depreciation can be used to generate a loss on your business income. So your Schedule F, if that's how you operate, can show a negative number as a result of bonus depreciation. 179 doesn't allow that. So you can bring it down to zero, but you can't really take a loss. Bonus also applies to a much wider range of property, which my next slide will go into in a little more details. But that will cover most of your equipment and then even a lot of your land improvements, single purpose structures, and even sheds and barns. Whereas 179 is generally only 3, 5, and 7-year assets. There's some exceptions for commercial properties, but we're not going to get into that. The other difference between the two, and this is actually one where bonus is less flexible, is that if you say, well, I'd like some deduction, but I don't want all the deduction. Bonus doesn't allow you to pick and choose by asset. You must pick and choose by asset class. So I could take bonus on all my 5-year assets, but not my 7-year, or vice versa. But I can't choose to just take it on one 5-year asset and not another one. So bonus generally comes in fairly large chunks. Whereas 179 deductions, you can really dial into the exact dollar amount that you'd like to take, because you can elect to take 179 on any amount up to the full price of the piece of equipment. These are items that you're going to want to talk about with your tax advisors, because these are choices that you get to make. Like you'll do the spending now potentially to get the equipment because it must be placed in service before the end of the year. But how much deduction you really need from it or how much you take can be determined before you file your tax return. So you have some time in hindsight to make some decisions. What all is subject to bonus depreciation? I said it was a pretty wide range of assets, and it is. So basically any asset that has a 20-year life or less qualifies. Nearly any asset. You can never say all with tax rules. There's exceptions to everything. But most assets with 20-year lives or less are eligible for this bonus depreciation, which gives you that deduction right away. So farm machinery and equipment, those are all 5 or 7-year assets. Those qualify. Breeding and dairy livestock, which are 3, 5, or 7 years, depending on the type of animal. Grain bins and storage facilities, those are generally 7-year assets. Farm fences are 7-year. Depreciable land improvements, so terracing and stuff like that, that actually has a life. Those would be 15-year, so they qualify. Your single purpose buildings, so your hog buildings and stuff like that, that would be a 10-year asset, so that qualifies. And then even general farm buildings, so your sheds, barns, shops, those are 20-year assets, so they also qualify. This is a benefit that farms get over other businesses because most other commercial properties have 39-year lives and do not qualify for bonus. The sheds, barns, and shops used on a farm typically would. So again, that's probably the single biggest thing from today's presentation. I hope you listen to the next 21 minutes, but the the main thing to take away from that part is that bonus is back, so you have a lot of flexibility for equipment purchases. Another big change this year, not as big as that one, but still could be big for many of you. And this is not a federal rule change, but a Missouri law change. So Missouri for 2025 no longer taxes capital gains. This can be a pretty big thing if you have certain situations that generate a lot of capital gains. Now, the Missouri tax rate, anything that happens in the state is always going to have less impact than a federal change because we're talking a 4.7% tax rate compared to the federal rates that range anywhere from 12 to 37% and lower for capital gains. But it still helps. Every little bit helps. So some of the things that would be exempt from Missouri's tax now would be long-term sales of investments, sales of farmland, equipment that's held, so equipment that you hold for more than a year and sell for more than the original purchase price. That differential between the sales price and your original purchase price is gain, and that's actually considered capital gain, so that would be exempt. And maybe a big item for our livestock producers is that livestock that's held for draft, breeding, dairy, or sporting purposes, such as cattle and horses held for 24 months or more, or other livestock, not poultry, held for 12 months or more, those are called 1231 gains, which is a type of capital gain, so long as it gets complicated, but so long as there weren't other losses in previous years that you have to recapture, that those sales may also be exempt from Missouri income tax. It's not a true exemption, it's a deduction, but it acts like being an exemption, so we'll call it that for ease of discussion. So that's something to consider. The federal change this summer has another item that would impact you if you're in a point where you're trying to transition your farmland. And this isn't necessarily, year end is not quite perfect to describe this situation because this is more of a 2026 and future thing. But if you're a qualified farmer, so you've got land that you've been using as a farm for farming purposes for substantially all the prior 10 years, and leasing this out to someone who uses it as a farm does count. And you're going to sell that to someone who is also willing to enter into a covenant to continue using it for farm use for 10 years. Falls within this sale of qualified farmland rule where you can actually spread the tax on the gain on the sale over 4 years. Doesn't do anything to change the amount of the tax, doesn't do anything to reduce it, but it does allow you 4 years to make a payment versus immediate payments in a normal sale. In this topic, remember, there's other tools that you might be able to use if you're considering selling a farm. Installment sales are one option. That means if you can sell or finance something, which is very common in parent to child or grandparent to grandchild type sales. If you can sell or finance, you don't have to pay the gain until you've received the cash. So it helps you match up the tax payment with the actual receipt of cash. Like-kind exchanges are also still available. That's where you sell the farmland and then you buy something else to replace it of equal or greater value, and that helps you defer the gain until that next item of property is sold. There's a lot of rules that go with like-kind exchanges. They're tricky with related parties, so obviously talk to your tax advisor if you're considering doing anything like that. So let's talk about some other ways to reduce income. I already mentioned in the intro, your business always has the option as a farm business, which is typically cash basis, you always have the option to accelerate some of your expenses or defer some income. You're probably all very familiar with that. We're not going to spend a lot of time of talking about that, but that's something that's in your back pocket. So there's other ways to consider reducing income, but also maybe not outlaying the money to someone else. So if you can get a deduction for money that's still yours, that's a great deal. Many farmers don't have access to the retirement plans that others get used to using when you work for a off the farm business, such as 401k plans and stuff like that, but that doesn't mean that they don't exist or can't be used. So simplified employee pensions or SEP plans and simple 401k plans, those are all options. Even a 401k plan in the right situation are options that work for farmers. Sometimes setting those, some of those are easier to set up after year end than others. And it's beyond the scope of this 30-minute call to talk a lot about the details. But if you don't have something and are going to have a profitable year, talk to your accountant about whether you can do something with a retirement plan. HSA contributions are also a great deal if you've got a high deductible health plan. You can put money into this account to use for future medical expenses, get the deduction now, don't have to pay tax on it later. Holy trinity of tax planning and the HSA contribution deduction. So look out for those. And as I go through all of this, I want you to keep in mind that deductions aren't always worth the same year to year. So there's a few changes that we'll talk about that might make a deduction worth more in 2026 than 2025. So anytime you're working with your tax accountant, that you need to consider when the deduction might be worth more and think about multi-year planning. I know that's hard in a world where you can't predict prices, you can't predict weather, but do your best to think about the big picture between multiple years when you're deciding what to spend money on and how to reduce your income. One of those deduction ideas that we have is if you, and I'm not going to spend a ton of time on this because a lot of you probably operate as sole proprietors, but if you instead are operating as a partnership S Corp, there's an option where you can choose to elect to pay your Missouri tax through the entity, and that makes that tax deductible on your personal return, whereas most of the time it is not for an individual taxpayer because there's what we call a SALT limitation, state and local SALT deduction limit. That limit's at 10,000. The recent rules changed it to 40,000, but most people with a pass-through business are still going to benefit from considering those pass-through entity taxes. Again, going through the full example is beyond the 30 minutes we have today. We have several resources on our website on this topic, but that's something I would love to talk to you about if you have more questions on that. I think I did see a question come
Yep.
through about the
Ooh,
timing of charitable, or not charitable, retirement
HSA.
and HSA contributions. And yes, those can be, it depends on the type of retirement plan. HSA contributions absolutely can be made until April 15th. Retirement plan contributions, if it's a SEP plan, those contributions can be made after year end. If it's, and that's the most common, easy plan to set up if you don't have a lot of employees. If it's a simple or a 401k, it's a lot more complicated. And so you need to talk with your attorney on that, or not your attorney, your accountant on that one. Thanks for the question, Troy. So some of the items to consider that aren't really business related, but just general tax planning. So charitable deductions are one of the main items that even a non-business owner can use for a tax deduction. For a couple years there was one where you didn't have to itemize your deductions to take a charitable contribution deduction. That went away. Well, it's back. So in the future, even those of you that do what you call short form tax reporting or just take the standard deduction, you're allowed to deduct up to $1,000 per taxpayer in cash charitable contributions. That's starting in 2026. So keep that in mind for the future. Another thing that they changed though with the new rules is that in the future, starting in 2026, some of your itemized deduction charitable contribution deductions are limited. One of those is that there's going to be a requirement that you have to deduct at least, or you have to contribute at least 0.5% of your adjusted gross income before the deduction becomes, before the charitable contributions becomes deductible. So this example is a deduction of $10,000 in 2025, or a charitable contribution of $10,000 in 2025 is a deduction of $10,000, but a charitable contribution of $10,000 in 2026, if your AGI is 300,000, becomes a deduction of 8,500 because of this 0.5% floor. They've also made it to where top bracket taxpayers, so people that are in the 37% tax bracket, are only going to get a 35% deduction from their charitable contributions. Something that anybody can do, though, if you often do contribute a fair amount, is to bunch your donations every other year. So our example here, you might have to go back and read through it. I'll go through it fairly fast. But the idea is that you want to maximize your use of standard deductions, and then also have as many itemized deductions as possible in the years that you itemize. So here's our example. Let's say you're someone who has 15,000 in state and local tax deductions, and that's deductible in the new rule, 5,000 of mortgage interest, and typically 20,000 of charitable gifts. That adds up to total itemized deductions per year of $40,000. If that's what you do every single year, you use a $40,000 deduction every year, total of 80,000. What if instead, rather than gifting the 20,000 in two separate years, you gift it all in one year? Well, in year one, you got the 15, the 5, the 40 in charitable, the 6, which results in 60,000 of itemized deductions. Then in year two, you've got the 15 and the 5. You don't give the charitable. Your total itemized would be 20. Well, that's less than the standard deduction of 31.5. So you just take the standard deduction. Notice the difference between the 2 years. For the exact same cash outlay, you've gotten 11,005 more in charitable or in total deductions by bunching your charitable contributions in 1 year versus spreading them out over 2. Just something to consider if you're charitably inclined and typically aren't getting the full benefit because of these itemized deductions not fully exceeding the standard deduction. So some other strategies for charitable contributions, one of these very specific or often used by farmers, is the methods by which you can make a charitable contribution without ever impacting, without even having to go to the itemized deduction. So by immediately removing that income from your adjusted gross income, you don't even have to worry about all of those limitations. So one route by which you can do that is if you have an IRA and if you are over 70 and a half, you can direct what would have been your RMD up to $100,000 to a charitable organization. It's called a QCD. And then you never have to pick that income up. You don't get the deduction, but by not having picked up the income, you're generally ahead. Something else that farmers do is rather than selling the grain and receiving the income from that, a direct in-kind donation of livestock or grain to the charity, and then they're selling it. So your result of that is that you just are never picking it up in income. So again, you come out ahead there or get a better bang for your buck for that donation. Another thing to consider if you have some investments, donations of appreciated stock are great. Rather than selling the stock and giving the charity the cash, you can donate the stock, and then the donation is valued at fair market value, and then you don't have to pick up the gain at all. So that's a great deal. There's a question about if you're less than 70 and a half and have an inherited IRA, can you receive a deduction for a QCD? I'm 90% sure the case is no. I think you have to be 70 and a half to do that. I do not believe that works with inherited IRAs. So something else that we'll talk about is not necessarily going to impact you, but if any of you do hire employees to work on your farm, this is something that might impact them. So one of the big parts of this summer's tax bill was something called no tax on overtime, but it's really no tax on some overtime. So it's just the half of time and a half, basically the compensation in excess of your regular rate, is a deduction on an employee's individual return now. the limitation is only 12.5 per person or 25,000 for joint filers, and that deduction does phase out once you get to higher adjusted gross incomes. But the thing to consider if you're an employer is that your employee may be needing some additional reporting information in order to calculate these deductions. So they haven't adjusted the withholding tables. This deduction on your employee's return should get them some tax back. There's going to eventually be additional disclosures you have to provide on their W-2, but the IRS has been lenient with 2025, so it's encouraged to provide that information, but there won't be penalties for not doing so. Also, bonus everybody's happy about, in 2026, 1099 NECs and 1099 miscellaneous don't have to be reported until you have got 2,000 of payments to a person instead of the 600 that you've had in the past. So yay for less 1099s. We're all happy with that. Okay, so my last topic, that's not really a current year item either, but something that you should always keep in mind is estate taxes. So as we all know, farmland has increased in value incredibly over the last several years. Equipment's worth a lot more than it used to be too. Farmers' estates are creeping up, and it's a lot of times not necessarily in cash and investments, it's in more tangible items. So you need to be watching out for estate taxes and what you can do to plan for that ahead of time. The law passed this summer did permanently increase the estate tax exemption that was going to drop back to the 5 to 6 million that it was years ago, but no more drop back. Right now, the exemption is 15 million per person permanently or until they change the rules again. And that is indexed for inflation. So a lot fewer people are subject to the estate tax and a lot fewer have to worry about it. You still have this annual gifting limit of 19,000 per person. So if you're doing some gifts, make sure you're working with your accountant to report those if they go over that limit. So just in general with estate planning, if you're someone that's very wealthy, has more than 30 million in asset, is going to be subject to estate tax exposure, work with an accountant and attorney to come up with some strategies to avoid that. If you're someone who might have estate tax exposure, there might be some things you want to start doing to hedge against the future appreciation of your assets and get that in somebody else's hands. If you're someone who's very unlikely to run into the estate tax threshold, your goal generally is to hold on to everything until you die with it so that your heirs get a step up in basis. Because if I gift you something today, you get my basis in it, which may be low if I've held it for a long time. If I die and you inherit it from me, you get the basis at that date, which is much higher. So any future sale has less gains. So those are awesome things to think about with estate planning. All right, well, I know I flew through quite a bit of that. Sorry for the speed, but just trying to get you all the information in the 30 minutes. If you have any other questions, feel free to provide them. There was a question about, do I have any input on Section 180 residual fertility? I know that's a hot topic and a lot of people have been considering that use. I do not have a lot of hands-on use with it, but have, read up on it a little bit. So if you have any specific questions, feel free to follow up with me and I'll see if I can help you out. And I believe Madison will be sending a copy of the slides. I'll let her join in and say what she's going to be doing there.
Yes, we this presentation is being recorded and then the slide deck will be shared. What I will do, thank you, Jessica. I'm dropping a survey link into the chat if you would take a few minutes to fill that out. That link and the slide presentation, any reference materials will all come out to you at your registered email address following this webinar within the next 24 hours. Do we have any other questions for Jessica before I dismiss you for the rest of the day? All right, well, Jessica, again, thank you for sharing your expertise, being able to answer those questions as they came in. That is always vital and important for us. Again, there's a link in the chat. Oh, there's another question. Oh, thank you guys coming in there. If you enjoyed today's session and would like to know have some additional education around this topic, around economics, just overall Missouri and agriculture in general. We are excited to invite you to our upcoming ag seminars. We're hosting one January 21st in Springfield and January 22nd in Chillicothe. More information can be found at myfcsfinancial.com and will also be included in that follow-up email. Again, we know your time is valuable, so we appreciate you joining us. And from all of us at FCS Financial, we wish you a very successful year end and a very Merry Christmas. Thank you.